share my screen real quick. Oh, now I'm being recorded. All right, everybody see that? Okay,
Aaron,
so
slides, like put them on the chat at some point. You don't have to do it now, but just suggestion.
I can do the official Washington Cares bulletin from their website, a page. It's a simple one-page flyer, and that's from their website. So I'm not an official from Washington, but this is something New York Life has put together for us to talk about Washington Cares Fund.
Very cool. Thanks.
Absolutely. So. All right, so the state enacted a long-term care insurance for all eligible Washingtonians. And again, it was created in 2019. It's going to be funded by worker contributions into a trust fund, and all workers in the state will pay 58 cents per every $100 of earnings, unless exempt, beginning January 1st of next year, 2022. The program participants will receive a potential access to $36,500 in long-term care benefits in the future. So it's establishing a fund so that if you were to be deemed need long-term care by your doctor of 3 of Washington's 10 average daily living, then you would be eligible for this if you've paid in enough. So the first state it is the first of all the states to do a long-term care insurance program of this kind. I'm sure Oregon and California will follow suit pretty soon. It launches January 1st of 2022. So let me move my screen real quick. So it starts in January the 1st of 2022. All W-2 employees in the state of Washington will be subject to the new 58.58% withholding of their pay. So it is a payroll tax unless they are exempt. Obviously, income level would dictate how much an individual pays in. Someone earning $37,000 a year would pay in about $18 per month. Someone earning $100,000 would pay in about $48 per month. So a couple making that $100,000 each would pay about $100 a month. Workers continue to pay in as long as they are working in exchange for participating in the program. Eligible beneficiaries of the program have access to $36,500 long-term care benefit pool. The benefit is expected to grow over time, indexed to inflation. We haven't seen really if they're going to do 3% compound. We haven't seen anything as far as what it's going to do, and it is not capped at the 0.58 cent percent. So it is subject to rise. So that's just the minimum initial premium rate beginning on 1/1 of 24. So how the fund works. Here's some additional details. All impacted W-2 employees in Washington will be subject to the withholding. And so if someone is coming in from Oregon, or if someone is coming in from another state, Idaho, they are subject to and they work in Washington, they're subject to the tax as well. Even though they will not be able to benefit from it, because you have to physically live in Washington to participate from that program. So the benefits are payable in $100 units, and they did allow it to be that you could put up to 10 units together to purchase, say, a $1,000 ramp. Family caregivers are eligible to be paid for caregiving if they complete the required training. That is not subject to the spouse because that's just inherent to the position. It would be an outside of spouse position. Inability to do 3 of the 10 average of daily living is a trigger for the benefits. And I researched on their site the 10 benefits for the 10 average activities of daily living for them is medication management, personal hygiene, eating, toiletry, cognitive functioning, transfer assistance, body care, bathing, ambulation or mobility, and dressing. And that does differ away from what most carriers consider 6 activities of daily living. So I'm just going to bring up what New York Life considers it. It's eating, dressing, bathing, transferring, toiletry, and continence. And a cognitive event such as memory loss would typically stand on its own with long-term care. But under the Washington CARES Act, the cognitive event just stands for one of those 10. So you would need 2 others to signal a long-term care event in order to participate in the benefits. So House Bill 1323 states that policy holders of a qualified long-term care policy by November 1st can choose to opt out of the Washington Cares Fund. So, and it has to be an approved policy from Washington. So where this gets a little bit tricky is some people have a long-term care rider on their whole life policy, and some of those will opt you out and some of those will not. Like with us, with our chronic care rider at New York Life, the way it's written and filed with the state, it will not opt you out. But other companies have filed it in such a way where it would opt you out. So this, in essence, makes anyone under 25 not eligible to be opted out unless they have an approved rider from their life insurance whole life policy. So, but November 1st is the guideline. So if you don't have a policy by November 1st and you're a W-2 employee, you will be subject to the tax. So as far as filing the paperwork to opt you out and to be exempt, that process starts October of this year and goes to December of next year. So the process, that paperwork is not on their site as of now, but it will be starting October the 1st. And that's when applications can go in to opt you out. It's up to the employee to opt them out of the tax. The employer doesn't do it. It's not by default. We as insurance companies, we don't file anything with the state saying that you have an approved plan. It is subject to the employee on their own to file that paperwork. So that's a QR code for the one of the state websites. You can certainly take a snapshot of that and go to the site. That's one site. And then there's the other one. Or you can go to wacaresfund.wa.gov. And it's basically all the information that I've described in this presentation. And this presentation is put together by New York Life. So thanks for listening.
Okay, I have a ton of questions.
Most people do. Most people do.
I'll try not to monopolize this whole bit, but as the is S Corp or shareholders automatically exempt, or they're automatically in unless they do it, they opt out?
If you receive W-2 income, you are participating.
Okay.
So 1099, you can choose to opt in, but for $36,500 compared to what you're paying in, you can get something on your own typically with a lot more benefits. And
does I'm not quite sure I'm following what the benefit is, what we're getting from it. So if I get sick and I can't take care of myself, my husband can file for me and he gets money for helping me. Is that what we're?
Well, going back to 3 of those average day activities of daily living, if 3 of the 10 are interrupted, say you're not able to bathe yourself, dress yourself, or transfer yourself from bed to chair or to the bathroom or that kind of thing, then that activates a long-term care event for you. And so those expenses could be reimbursed by the state if you've paid in 10 years or 3 of there's that initial period whenever we start this in 2025, whenever the benefits are actually dispersed out. So if you were to have an event and you've paid in 3 of the 6 years and you've worked 500 hours, then you can actually participate from the on the benefits. Does that make sense? Basically, you pay the doctor, you pay your expenses for a nurse coming in, for a facility, and you're reimbursed. And it's a lifetime benefit of $36,500. Now they're saying that it's going to grow with an inflation rider on there. They haven't announced what that's going to be. And then my guess, as with any program, it's probably going to go north with the percentage that's taken out of our paychecks to compensate for that amount of money. Because the initial results that they found that beginning in 2025, it's not going to be viable, and they're going to need extra money.
Mm-hmm. So how does that work with aging parents? So they don't have a W-2, they're not putting into it. Does this affect, or are they able to get it, or?
No, if they're already aged out, they're not able to get in. Now there is one benefit of the program, and we've heard all the negatives. If the people that are talking about it, that it's not enough money, long-term care costs a lot more than this program is going to provide, those kind of things. There is a benefit that it actually does provide for people who are working, paying into the system, and may not qualify for long-term care, because the state is allowing for companies such as New York Life and other companies to wrap around this program so that they can at least get long-term care benefits and get more of it. So there is some positives to this tax, but it is the first payroll tax in Washington. So there's pluses and minuses with everything with that,
And then the other
Darren,
go ahead, Neil.
I was just wondering, how long will they pay this $36,500? Will it end at a year, 2 years, 3 years, 5 years?
When the money's,
how much
they will only pay $36,500 total. So it can be interrupted so that, it's a lifetime benefit. It's not $36,500 a year. It's $36,500 total. So say, and like with my dad, his long-term care was progressive. So it may start off with a nurse, a healthcare aide coming in three hours a day. And then so that's reimbursed. And then it may get to where, there was times that we didn't need someone to come in for my dad. So that was interrupted care. So you can have interrupted care, and it doesn't opt you out or disqualify you. It's just when you need the care, and it's paid up to the $36,500 or until the benefit, if the benefit grows to $50,000 or $75,000, then that will be the new cap at that point. But right now, it's a lifetime benefit of $36,500.
Darren?
Yes, sir.
If I have employees in Utah and Texas and California and Oregon, are they all going to get taxed for this and have absolutely no capability of receiving the benefit?
If their domain is, if they're paid through your office in Washington and not through their domain being Utah, they're going to be taxed. But if their domain is Utah, and they're paying Utah taxes, then no, it's not going to affect them. But someone that is physically driving into Washington and working in Washington, and they live in another state, they're going to pay the tax. Just like there's a portion of my income that I pay to Oregon every year, and I never get any of those tax benefits. It's the same way. It's reciprocated this way, so that any Oregonian that's coming into here and working in our state, they're going to pay the tax and have no possible way to collect from this benefit because they don't live here. If you move out of the state for more than 5 years, you have forfeited your right to the benefits of the $36,500.
But if you were never in the state, let's say, like you said, I've got some employees that live in Texas and some in California. they're not going to ever have an opportunity to participate in the benefit. They're not even driving into the state or flying into the state, if you will. So they're still going to have to pay though, right?
If they're paid, if they are if they're a virtual employee, they can typically, and Sean can certainly help us out with this, they can choose their domain as their state where they're living.
In your particular case, Brian, no, we will
Okay.
not, they will not, because we're doing Utah, Pennsylvania, California tax, so they will not be Washington.
Yeah.
But we go back to in person and our Oregon employees come over to the border again, they will be taxed.
So it's anybody that actually works in the state of Washington
Yes.
is going to be subject to the tax, regardless of whether they're resident or not. If they're earning income while they're in the state of Washington, then
That's correct. That's correct. And the issue is that not many people know about it. I mean, I know some, like if you're paid through ADP and those kind of companies, they've sent out the emails notifying your employees of this happening. And so that, so that people can make themselves aware and do something on their own, whether it's New York Life or another company. I encourage people to check out their options, because you could conceivably pay more than what the benefit is, with your tax, with where your income is. So that certainly doesn't benefit that person. We all know how many's experienced the cost of long-term care in a member of your family? We all know that $36,500 won't even come close to covering it. So it will help. It's a tax for Washington and not the Washingtonian to help with those expenses. It is a step in the right direction to help, because 95% of America is on the friends and family plan. The trouble is not many people know that they're on that plan until it happens. So the good thing about this program is it gives us the motivation to make a plan, because the long-term care cost is one of the highest things on the list that can wreck your financial plan in retirement. So everybody needs to have a plan. And so this is getting us talking about it. So that's another benefit of the Washington Cares plan. But if you choose to opt out, it's really key that the November 1st date. You have to have a plan in place. And long-term care policies typically take 4 to 6 weeks to get approval. And then I've heard from one company, not ours, that the underwriting is already getting backed up, that they're no longer taking anyone under 40. I don't know how they can discriminate there, but they're no longer taking any long-term care policies for anyone under 40 starting next week. So definitely underwriting is starting to feel the squeeze of this new program.
Hillary, I see that you've got quite a few comments. Do you want to introduce yourself and tell us a little bit more about where you're getting information?
Hi, my name is Hillary Gorham, and I work for Clark Regional Wastewater District as the Human Resources Generalist. Thank you for having me in the meeting today. I learned a lot of information from doing research for our district so that we could inform our board and our management team and our employees so that they would hopefully have enough time here to make some informed choices. So I hopefully am just adding some valuable comments for other employers to consider, in addition to what Darren has been sharing with us.
And thank you. You got at least 2 accountants on the call here with you. And I know any other information you have that doesn't make me start from scratch would be amazing. And I know Colleen would appreciate that too, unless Colleen, you've already done your research. But and I know there's an Oregon one that's also starting January 1st, but I don't know much about that one yet either. I have clients in both states. But yeah, Hillary, thank you. And if you want to share more, feel free.
Thank you. Yes, we did prepare, HR prepared a district FAQ for our employees, and I can certainly look into sharing that with anyone who may be interested. It is lengthy. It's about 6 pages because there's quite a bit of information out there.
Oh, that would be great. Yeah, and Neil has my information. You can get it to Neil, or I can put my
Okay.
email in the chat here for you too. That would be great.
Absolutely. Thank you so much.
And there is a one pager in the comment section that Kyle put up there that comes from the Washington website. It's labeled LTSS Trust Act one pager information. And that's what the state wants you to know about the program. It is just a very high level description of what Washington Cares is. And I applaud Hillary with HR of getting it out to their employees, because I think every Washingtonian needs to have the right to be able to make a decision for themselves as far as what plan to go with.
Did I hear correctly that Portland, or not Portland, but Oregon is going to be introducing their own program much like this soon?
Well, I mean, we have that kind of reciprocal relationship. Whatever Washington does, Oregon does, and vice versa. So I think once the plan is in effect and they see how it goes, I think it's certainly going to be on the table.
And if you're then, if you're working in Washington but living in Oregon and they have a plan, you will be taxed under the Oregon plan?
Well, we don't know what that is because it's not there yet. So they can write it however they want to. But right now, the way the law is with Washington is if you work here and you collect W-2 income from Washington, you're going to be subject to the payroll tax.
So I would add one thing. I believe from my research that people will have until December 31st of 2022 to opt out. So I believe that if they don't opt out before then, they'll be charged that tax. But from my understanding, that is the last opt-out date. So even though it's starting January 1st for the tax, you will have until the end of 2022 to actually opt out. And that, is because of people making up their minds, changing, underwriting delays, company delays, all that kinds of things. And then to add on to what Darren said about, companies not accepting people under 40, I think a lot of their concern is that younger people are going to get a plan in place to meet the requirement to not be taxed, show that to their employer, and then cancel the plan. So that causes a lot of losses for insurance carriers. And so I think there are going to be some changes in their underwriting and what they allow to prevent a lot of that wasted time and lost money from people getting a plan and then canceling it a month or 2 or 3 later just to meet that I got one, don't tax me quota. And each company will have different underwriting guidelines. So
Jamie, are you saying that if I have till the end of 2022 to find an alternative program, but I'm understanding that we start having to pay into this before then?
Yeah, January is, from my understanding, when we'll start paying for it, but they're giving us through the end of 22 to officially opt out.
So if let's say I pay into this thing for 6 months and then I put together my own program and I opt out, do I receive a refund for what it is that I just paid into?
No.
Not that I don't think you do, no.
Jamie, November 1 is the deadline to have a policy in place for yourself. You have the ability to opt out to December the 31st of next year to actually file in that paperwork with the state. But you have to have a policy in place by November 1st of this year in order to opt out.
Okay, there you go. Thank you for the clarification.
So if I have a lot of employees that, let's say, live in Oregon and they're under 40 years old, they are going to have to pay this tax, have no chance of opting out.
No, there's still companies such as us that's taking under 40 years old. Our minimum age is 25 and up. The only way someone under 25 can opt out, to my knowledge, is if they have an approved rider on their whole life insurance policy that would opt them out with the state. So, and I certainly don't want to take Jamie's time and Sean's time today, but I do appreciate it. There's a lot of questions, and there's still some ambiguity with this because they were finalizing the law 2 months ago with it. As far as the opt-out dates, it was changed from, they made it January the 19th of 2019. So you had to have a policy before then. Then they made it January of 2021. I mean, sorry, July of 2021. And then the official language moved it to November 1st of 2021.
So for those of us who are experts in so many different things, but not insurance, as a layman, where do you go to get this long-term care? Through New York Life, through Jamie as American Family? I mean, is that what we're through our, like, I'm health insured through Kaiser, but I've got life insurance through somebody else. So you just go to our agents? Is that what we're looking at?
Absolutely. And not everybody deals with long-term care. When long-term care started, there was a plethora of companies that did long-term care. Those have kind of dwindled away and gotten down to about a core of 12 folks. There have been some companies that jumped on the bandwagon and is sending notices in the mail, and they've just literally sprung up for this Washington Care. So as someone that's in the business, and I'm sure Jamie will echo this, it's very crucial who you go with, the company that you pick, because it needs to be a company that's going to stay around. What happened with some folks that jumped on the bandwagon, cheap policy was the key, and they bought in to long-term care and they thought it would be there whenever they needed it, but that company actually is no more. And they basically settled with the client with an X amount of dollars, and that client's not eligible to, by that time, they've aged out or they've health out of being able to get another long-term care policy. So you want to go with the big six long-term care carriers, because this policy, if the company gets to the point where they want to exit out of long-term care, they can pay you out with the benefit of where you stand at that point, and then you're kind of on your own. So this is a policy that you definitely want to be careful with who you're with.
Yep, I would echo that. Be careful of getting mailers in the mail and picking the cheapest one, because there's lots of optional coverages. And Darren might give you a price that's more expensive, but it's more inclusive and is more robust and comprehensive. And you get a mailer in the mail that says sign up for $50 a month, and it's the bare bones, might even be worse than the state plan. So Just be careful of what you're buying, and you want to go with a quality company that's financially strong. So if anything happens, they're there when you make that claim. So totally true.
And long-term care policies typically don't lock in the payment. It is subject to price increases. And so you want to go with a company that hasn't increased so many times over the course of history too. But to answer your question, Sean, yes, we're certainly available as agents to talk about long-term care.
Okay, guys, I'm going to jump in. I know we could talk about long-term care for the rest of the day, but I'm going to jump in and talk a little bit about some changes in personal insurance. So I know that this is the Hazelville Salmon Creek Business Association, but even as business owners and people in the community, we all have personal insurance. Just want to take probably 5 or 10 minutes to share about some big new recent changes, again, in the state of Washington. Lots of things getting shook up here. Let me share my screen. Bear with me just a minute. And I put this in comments. It's nothing groundbreaking to read here, but have a little share out. Okay, hopefully you can see that. So in each state, there's an insurance commissioner, Washington Office of Insurance Commissioner, and they are in charge of all of the insurance companies in that state. So they're in charge of making sure their pricing, their filing, what they're doing, everything is in line and in order. And this insurance commissioner, ours, recently, last month, issued an emergency order to remove credit scoring for pricing on personal insurance in the state of Washington. So what does that mean? Personal insurance, cars, homes, motorcycles, ATVs, side by sides, all your personal insurance. So not your business policies, but your personal policies. Credit, that's a touchy subject. What do you mean my insurance company knows my credit score or gives me a price based on my credit? It's nothing new. It's been around a long time. As far as I know, every insurance company uses it and does it. And what it is it's an indicator of risk for the insurance company. What is the risk of this client? Are they low risk or are they high risk? So it's similar to any financial industry. We have banking, we have mortgage, we have these different things. These different companies use people's credit score as one of the factors to give them an interest rate and to give them a price based on their history of how they've been and paid their bills. So insurance uses it as well. There's other factors in their price. That's not the only factor, but it does accurately predict how likely someone is to pay their bill, how likely they are to have claims. So it's not just about paying their bill or not paying their bill, but there's lots of factors that go into this, and one of them is about claims as well. And so again, similar to financial industries, other financial industries, if you are someone with an excellent credit score, you are going to get a lower insurance price on average. Not every time, not every company, but on average, you're going to get a lower price because you're a lower risk person. The person who doesn't have credit, who's proved that they are higher risk and poor credit score, they could pay a higher price. So these aren't exact models or exact pricing of one exact person, but just a generalization to show that it ranges based upon your score. So what this means for us, what this means for myself and all of you and every single person in the state of Washington and every insurance company is starting June 20th, so just a few weeks from now, no insurance company will be allowed to use credit as part of their pricing for personal insurance. So in short, this means that those credit scores and those factors are going to get neutralized. So the people that were high and low, they're going to all be brought to middle and say neutral. So what this means is that the people who in the past have had more of the poor score will actually see an average score, and it's going to bring their price down to somewhere in the middle. And then the opposite is going to be true for the excellent score people. So if you have a better than average or excellent score, it's going to bring your score more to an average in the middle, and it will actually give you a price increase as well. So that's what everybody loves to hear is price increases. Why is this happening? What's going on here? There's about 200 insurance companies in the state of Washington. They all band together to form an injunction and trying to stop this from happening. They were not successful. So it is moving forward here in a few weeks. We don't know how long this will last. We don't know if this will be forever. We don't know if this will get overturned and changed back next year, the year after that. And then also, like Darren talked about, we don't know if other states will follow. It's kind of that, hey, watch and see what happens in Washington. They're the guinea pig. And then Oregon will adopt it, or California, or Colorado, or some of these other states. So a lot of unknown. The reason that he's talked about doing this, I don't know if people care or not, but he's talked about and tied it to the CARES Act, and that people who have been negatively or have been affected because of COVID and maybe not able to pay their rent, and when that comes off, and when companies are allowed to impact someone's credit score because they haven't been paying their rent over the last year, he was afraid or fearful that people's credit score was going to be damaged because of that, and then thus causing their insurance prices to go up. So he didn't want that to happen. So he said, okay, we're going to use this to say that insurance companies can no longer use credit scoring, and it'll be fair for everybody and equal. How how will it impact you guys? So if you're making an insurance change, if you're buying a house, buying a car, something like that, after June 20th, you will be getting the new price. But how will it affect your current insurance, your current car and current home insurance? That will most likely happen at your next renewal. So if your renewal is August or October or September or November, December, next January, whatever, it will then be impacting you when your personal insurance renews next, whenever that is. So as far as I know, there's no way out of it. There's no way to opt out of it. There's no new insurance company to go to that's not using it or being affected. It impacts every person unless you move to Oregon or Idaho. So more good news for everybody. And again, don't hate the messenger here. I just wanted to share and kind of give you a heads up of more big changes recently announced and coming out here.
We probably don't vote for the insurance commissioner, right, Jamie? Damn.
Yeah, good point. That is an elected official. He was just re-elected this year. He does have 3 more years.
Yeah.
His last name is Kreidler, just to put that in the back of your mind for 3 years from now. So, yeah. You know, only way I know of trying making change is to speak out to your local representative and tell them how you feel about this and tell them to take your voice up to him and to the state. It's the only way I know to fight this, and it wouldn't be anything fast.
Well, legislation can override it, right, Jamie?
As far as I understand, and that was the emergency injunction that insurance companies filed, but the judge did not side with us. He sided with the insurance commissioner. So it's not over by any means. It will be continued to be fought. It's just a matter of what will happen, but it is happening for now. Any thoughts, questions, concerns? I don't expect clapping, but you know.
Just close your eyes for a minute and all hell breaks loose. That's right.
That's exactly it.
Thank you for letting us know about that.
Well, these are some exciting topics, aren't they? Long-term care and then credit.
Well, they're affecting all of us financially. So, I mean, there are things we need to know about, but it's frustrating that the insurance or those of us with good credit are being penalized and those with poor credit are being maybe rewarded, or I don't know if I'm saying that correctly, but you know, it's just, oh gosh.
Totally unfair, I know.
Yeah. And Darren, with the long-term care insurance, who was this initiated as a way to prompt Washingtonians to purchase long-term care because the cost of long-term care is just skyrocketed out of control, and the state is having to absorb some of those costs, or else healthcare providers are not getting paid, or what was the reasoning behind that law?
I think it's been expressed as that, but it's also been expressed that because like the 95% of America is on the Friends and Family Plan, that ultimately, whenever it goes to Medicaid, you and I are paying for it as taxpayers, and so it's to offset what Washington's going to have to pay because of our increasing aging population, is my understanding. And just to clarify, I know there's some comments in the chat. I went to the website, and you can go for yourself at let me get the site, wcaresfund.wa.gov, and it says, and purchase a qualifying private long-term care insurance plan before November 1st of 2021. What gives us an issue is the opt-out time for filing that with the state, and that's till November of next year. December of next year. So you have that window to put in that paper to the state, but if you don't have that approval by January 1st, they're going to start. You know, it's up to you to tell your employer you've got a plan. It's up to you to tell the state that you have a plan that will opt you out. And that paperwork has to be done between October this year to December of next year. But you have only until November 1st to get a qualifying plan.
So
I find it
Darren,
odd.
Oh,
I
wow.
find it odd they're putting a deadline on that when the goal is to prompt people to go buy a plan. So even if you've paid into it for 2 years and just haven't gotten a plan and you decide you're going to get a plan, then it's too late to opt out, which kind of defeats the purpose of, I don't know. I don't know if you kind of get my train of thought on that, but I
Yeah.
don't know why they would put a deadline on it.
Well, we almost didn't have November 1st. It was almost July of this year. So it was moved to November. So that's a good thing. So,
Darren, I thought I heard you say earlier that it's up to the employee to submit the information to Washington State, but you just said something that I misunderstood, I think. So the employee goes and submits it, and then am I, as the payroll provider, supposed to understand that this was a qualified plan, or do I get something from the state? Does the employee have to give me something from the state that says it's been accepted?
so the employee has to notify the employer that they have a plan. The employee has to submit to the state a copy of their plan, and the state says yes or no, whether it's an approved plan or not.
So for example, if one of my employees got their plan, it's effective November 1st, but the state doesn't approve it, takes 3, 4, 5 weeks or a couple of months to get it approved. January 1st, I got to start deducting no matter what, until they give me a document that says the state has approved this plan and you are not subject now.
From the employer, I'd hate to speak to that. I just know that it's the employee's responsibility to notify the employer, and the employee's responsibility to notify the state that they have a plan.
Okay. Hillary, do you have any comments on that?
I will be sending out that FAQ to the addresses that have been provided. It's very complicated. Can you repeat the last question though, because I might have additional information.
Yeah, I just was asking if the employer, so the employee's got to submit it to the state. They've got to also submit it to the employer. Is the state going to give the employee something to give the employer, so we have a documentation that their plan was accepted?
So my understanding is that the state, at least the information that I've seen out there currently, is that when an exemption is provided to the state, my understanding is that there will not necessarily be a thorough vetting of what the person has provided, and I don't believe there will be any information provided back to the employer. It is the responsibility of the employee, however, to inform the employer whether they are exempted or not, and that includes all new staff now moving forward, so all current staff and new staff. But at this point, I do not believe there's anything I've seen that indicates the state will be either fully vetting the plans. I think they've even indicated, that they're not going to do that at this time, but they do reserve the right to do so at a later date. And it is the employer and employee's responsibility to communicate and manage and administrate those changes, or not changes, but administrate the status for all of the current and new employees moving forward.
Okay, that's really helpful. And I've got a lot of research to do, and I look forward to your document. Thank you so much. Dan, thank you too. And Jamie, both of you guys, great information.
Absolutely.
Yeah, and to add on to what Hillary was saying, it's just a guess, but a lot of companies or people think that the state will be so overwhelmed with this that they're not going to have a great follow-up process to see who's opted out, and if they opt out appropriately with a plan, and so it's going to be kind of a mess for a while.
Well, the wording on the site says that it's a permanent opt-out, and I think that's what's given people the illusion that once they opt out, it's done and they can cancel. But there's nothing saying that the state can't go back and verify that annually with the same process. So I think people that are jumping into the system, you know, and with that intent of just making the payment, getting the plan, and then opting out, I think that's going to be short-lived. I don't think, and once you're past this opt-out time, that is something that's in the legislation. It's a one-time opt-out period, and the horizon's done unless they rewrite the legislation and put and change the opt-out time to another opportunity.
Wow. A lot of information, a lot of information right there. I'm sure there'll be a lot of questions coming at a later date for all of you. You know, Sean, Aaron, you know, as well, you know, as Jamie said about this. And I'm sure there's going to be changes coming as this starts opening up. There might be more people realizing just what the outcome of all this legislation is going to do and how it's going to affect the populace here. So it'll be interesting to follow this and see just how it just blooms. I want to say that. So we've got a little bit more time other than the announcement of our in-person meeting in July and our viewing party at the 99 Street Saloon at 1:30. Is that correct? Is that when we're going to be doing the viewing party?
Yes.
Yes.
So 1:30 on Saturday. Everybody's welcome to come. Bring family down. That's what Casey has said. You know, is just bring everybody down for a really fun viewing party.